This is an update for the Ftse 250, and I'll also be taking a look at some macro. Before I start, please remember that I do these videos just for fun as a hobby and always speak to a qualified investment professional before making any investment decisions. So when I look at the Ftse 250, there's a clear increasing gradient for how the Ftse 250 has increased ever since we had the credit crisis and the rollout of new Keynesian economics doctrine, that being of having extremely low interest rates and lots of money printing in order to meet the government targets of 2% inflation, 2% GDP growth, and low unemployment, with the stock markets and house prices kind of secondary objectives. So, over the last 2 years, there's been a drop away from this trend line. You see that the FTSE 250 peaked in August of 21. So that's at least a kind of 2 year bear market. But we're in a very interesting descending triangle formation at the moment, and also what looks like a double bottom. So interest rates have been kept at 5.25% now. Quantitative tightening continues at a gentle pace, as you can see here. And inflation does appear to be going away as a problem. Now, I don't like to use the year-on-year data. I prefer to use month-on-month CPI data, and I package these into quarters for this graph. And we can see that the trend is clearly a downwards trend in terms of inflation. And the data from October would put us right on target of well below 2% inflation. And even if you use this kind of more annualized number I've used, it's still on the lower side and trending lower. GDP growth for the month of September was actually bang on target at plus 0.2% for the month. So the long-term trend for GDP growth is kind of stagnant, but the current data is well on target. Unemployment is doing great, with very low unemployment still, and house prices are kind of doing okay. So in terms of inflation and GDP growth, it really does appear like maybe the inflation was transitory after all. And in terms of the current data, we're all bang on target. So there is a good argument for us to move positively from here. The stock markets tend to lead the macro actually. So we could see us rebounding back up off this double bottom, and then over the next few quarters see the macro data improving. Another possibility though would be if this trend was to continue, so we'd actually start having deflation, and then if the GDP went from being just stagnant to actually contracting, then we would have a technical recession, and that would see the stock market going lower from this technical formation. Now, of course, this entire new Keynesian economics model relies on the somewhat privileged status of the pound sterling, which does represent 5% of the world's currency reserves. So looking at the pound sterling against the Swiss franc, obviously over the years, the value of the pound sterling has diminished a lot, but it's kind of stabilized. As you can see, it's actually stabilized really over the last year. So no kind of imminent danger there in terms of the yield curve. And bear in mind that here's Japan, which is what a yield curve is supposed to look like. And of course, the yield curve for the UK has been inverted for quite some time, and inversions famously are supposed to predict recessions. It actually flattened recently, but then after the most recent data, it reverted back to this inverted shape. So when the economy's all kind of stabilized, then you expect to see a normal yield curve. And so really the fact is that because we have this strange looking yield curve, we have to accept that there's certain risk here. I've been looking at the government debts and fiscal deficit, and although these numbers do look high, and here I've got the government debt as a percentage of GDP, and you see we had the step change following the bad government decision making during COVID, which which is kind of stable at least, even if we are kind of 20% poorer than they were before COVID. It has stabilized. And in terms of fiscal deficit, the fiscal deficit is currently 7% per year of GDP. So again, although that's not normal, it has kind of stabilized. And then when I look at the fiscal deficit, we see that we're currently spending about 15% more than we get in taxes. And again, the UK does seem to be off kilter significantly from before COVID, but it's not really a kind of death spiral yet. So, in terms of the pound sterling and confidence in the UK government, it's really strained, but it doesn't seem to be crisis, but it's certainly an elevated risk factor that we've got to kind of consider with amongst our overall decision making regarding the macro data. Finally, we need to point out that beyond all this, there's the international undercurrents. There are inflationary forces, and currently they have particularly the energy and supply chain issues that these have all abated, so they've kind of gone away actually. And there are also though these deflationary forces, and if it wasn't for these overall deflationary forces, particularly globalization and technology, this new Keynesian economics wouldn't have worked. They only got away with all the money printing because of these deflationary forces. So although I haven't got a particular opinion on the balance here at the moment, you've got to bear in mind that the inflationary or deflationary undercurrents, which can then affect everything else overall. So back to the yield curves, and I've been considering what would we expect to see happen with the yield curves according to different scenarios. If we were to have this all hail new Keynesian economic scenario play out, or the recession is real kind of scenario play out. So first of all, I've got the soft landing scenario. Let's say that GDP continues to kind of stagnate, but inflation stays in control. Then what if the central bank starts reducing interest rates? Well, of course, that would then lower the short end of the yield curve. The central bank reduced interest rates. And then if we didn't have inflation and everything then got back to normal, then you'd expect the long end of the curve to reduce, and then we would have a more normal yield curve. Another scenario, though, is that we have a similar thing. Whenever they try to drop interest rates, it then leads to pulses of inflation, and then that would lead to the 5% base rate being entrenched over a long period of time, and then the longer end of the curve would would basically go up, be back to a kind of 1990s kind of scenario, but the yield curve will have gone back to normal without there necessarily being a big recession. So there are different mechanisms there whereas we could kind of avoid a recession and then we would then go back to having a normal yield curve. However, perhaps the most orthodox mechanism, which I haven't drawn, but you'd end up with the same, would be if we actually just have a proper recession. So that would mean that the inflation that we see here continues to trend downwards. The GDP continues to contract and then becomes negative GDP growth. That would actually be a proper recession, in which case this inversion is kind of like a normal thing, and then as the whole economy collapses, then they can lower interest rates, and then you get a normal yield curve again as we start a new economic cycle. So to summarize, in the long term, it looks like inflation and GDP growth data is starting to correct itself and is actually looking well on target if we look at the current data. The question is, are we going to stay here and then gradually improve from now? In which case, following this double bottom and descending triangle, we could see the FTSE 250 performing very well from here and then leading positive macro data moving forward. There is a bear case scenario, however, where these trends undershoot in terms of CPI and also the GDP growth. So then if we do after all end up with a proper recession, then that would see the FTSE 250 breaking below this technical pattern. Myself, I'm very defensively positioned at the moment and with hardly any equities exposure, and I'm just going to wait this out. We took a look at the yield curves and I discussed different kind of scenarios, how they could move into a more of a normal profile. So that completes my update for the FTSE 250. It really does look like this 2-year bear market could resolve, but I do think it's worth waiting a couple of quarters to know for sure, given the uncertainty we have both on the macro side and also the currency side. So I hope you found this video useful and look forward to speaking to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. You'd be really stupid to make any kind of investment decision based on this video. Always consult a qualified financial advisor before making any investment decision. Prices can go down as well as up.